The Forex daily cycle. The first thing that is needed to trade consistently in the Forex is an understanding of the daily cycle that all pairs follow most of the time. Some days when a pair is trending strongly, these setups occur less frequently. But understanding the cycle will give you a big advantage in your trading when used in conjunction with the quarter series indicator. This is an example of a daily cycle. This blue box represents our Asian session. And this blue box here represents the London gap, which is 1 hour before the start of the London session. And this box represents the 1 hour gap period before the start of the New York session. Most days a pair will have a pattern that looks something like this. It'll either consolidate during the Asian session and then shoot down, or it'll consolidate and shoot up, and then it will set their trap moves. The dealers will set their trap moves, and then the pair will reverse back towards the intended trend of the day. At the start of the new trading day marks the start of the Asian accumulation session. During the Asian session, the dealer will shoot up 15 to 20 pips, and then he will drop 15 to 20 pips. And then he will trade in a sideways motion. The reason that he does that is he wants to collect contracts. If he has 50 million long holders and 100 million short holders, guess who's going to get punished? The shorts, of course. You see, to the dealers, it's all about the money. The time frame of 1 hour before the start of each London and New York session is called the gap time. At this time, the dealer takes time to access their books, and then they signal the dealers to move price accordingly. The Asian accumulation session is set. The price moves quickly away from the blue box very quickly. This is done to induce traders to take a position in the opposite direction of the real intended trend. This is usually done in 3 candles, but it can be extended over a 2-hour time period. The first hour before the start of the new session, a pullback will be made. The dealer will hold the level, and the TDI will signal an oversold indication. This will be identified with the RSI green line. It will be outside of the blue band. This reversal pattern will usually be very close to a Rock Manager quarters theory number. The dealer then holds the level for 60 to 90 minutes, up to 2 hours. A buy can be placed with a very small stop loss hidden below the Rock Manager quarters theory number. Again, you can notice how the TDI becomes divergent. TDI was out of the band, and then it cycled back up. And this is one of the major trade triggers, along with the time of the day, that you can use to identify these trade setups. The dealer will pull away very quickly from the low of the day, and the real trend of the day will begin. The pair will make 3 cycles and then end the day in consolidation. You can see as the pair cycled up, started cycling up, it made one move, cycled back down and made another move, cycled back down and made another move up, and then they ended the day in consolidation. Again, this is the daily cycle with Rock Manager's Forex software. This move, if you would have placed a buy right at the round number of 1.500, the pair cycled up 150 pips total for the day. This is the daily cycle without the Rock Manager software. How would you know what to do? And this is the cycle with it. Most times you will find your entry at the start of the London or the New York Open. I find it best to avoid the Asian session as we rarely find any strong enough movements to get our stop losses to break even. These times are shown on the blue boxes, and the reason for this is because at these times new dealers come to work and they're given new directions. Again, the daily cycle. This is on the pound Swissy. Pair cycled down, made the exact same movement, cycled back up. Ended the day in consolidation. Another setup here. The Asian session is set. The price action moves outside of the blue box. A false move is made to induce traders to take a position against the intended trend of the day. And this is usually done with 3 quick candles to form a high or a low of the day. There will be some sort of reversal candle pattern created. And you notice that the TDI trigger is when the green RSI line is outside of the blue volatility band. And you can see here, this is a small quarter point. And what you can do is, when you see this second leg like this right up against the number, you can enter a sell trade and you can have a 10 to 15 pip stop. And in this trade you could have an easy 50 pips. Pair cycled, like I said, up to the small quarter point, cycled down, and it broke another small quarter point, and then it bounced right at the hesitation zone for an easy 50 pips. Again, you can see that the TDI was at extreme level when it cycled down to the hesitation zone. The TDI RSI line was outside of the blue volatility band. The price stopped right at the hesitation zone and it ended the day in consolidation. Here's an example on the pound New Zealand. Here's the Asian accumulation session. Stop hunt out of the blue box, usually done with 3 quick candles. Held the level for between 30 to 60 minutes. Bounced right on a hesitation zone. Again, the trade trigger was the TDI is out of the blue band. You could have bought at this point with a 10 pip, 15 pip stop set below the hesitation zone. And in this trade, the dealer took the pair up, and there was 130 pips possible on this trade. And there's your 3 pushes right there. 1, 2, 3. Here's an example on the Euro Yen. The Asian accumulation is set, the pair cycles down, and then it makes very quick movement to the downside. And you can tell when the pair is getting close to the end of its run, because the dealer will push the candles down very quickly. And what does that do? It makes people want to go short. And then the dealer says, oops, sorry. He uses the hesitation zone, in this case at 139.25. If you had this software, you would know that that number is there. You could place your stop loss just below the hesitation zone, 10 to 15 pips, and this pair continued up for over 100 pips for the day. Again, the TDI formed a small W out of the blue band, and it started up. Here's an example on the pound CAD. Same thing. Asian accumulation set, stop hunt low, The dealer in this case, he cycled up, then he cycled back down again, but he bounced right exactly at a round number of 1.800. Anywhere in here, you can tell with the TDI being out of the band and it's divergent, you could have placed your trade 5 pips above this round number with a 15 pip stop below, and then the pair ran 125 pips in 3 moves. Here's an example with a pound yen. Asian accumulation set, stop punt to the high, bounce right at a small quarter point, TDI out of the band, that's your entry signal, 15 pip, 20 pip stop above the small quarter point. The intended trend of the day was down. The pair bounced exactly at a small quarter point and came up, and during the New York gap time, the pair cycled back down. It bounced again, formed the second leg of the W, and the pair cycled back up. So you could have had an easy 50 pips on this trade, and you could have taken this trade for an easy 100 pips. That's a total of 150 pips. Here's the last example on the Euro Aussie Asian accumulation phase. Cycled down against a small quarter point, cycled up, cycled back down, created a beautiful W. TDI was out of the band. You can buy with a 15-20 pip stops. Your stop loss is set below the quarter point number, and this pair moved up in 3 pushes, 125 pips. The numbers don't lie. When you utilize these numbers in your trading, they provide you with excellent areas to hide your stop loss behind. They act as invisible force fields that contain price action. As you can see, using the Rock Manager Forex software with the quarters theory indicator and the trader's dynamics indicator, you will truly learn how to trade price action based on the hidden numbers that control the Forex. Thank you for taking the time to watch this video.